presentation contains current opinions of Moe Javaid, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello, everyone, and welcome to the Compact Market Wrap Weekly Update for April the 8th, 2026. I'm Moe Ansari, President of Compact Asset Management, joined by Javaid Ansari, Executive Vice President with Compact Asset Management. Thank you for joining us today. First of all, a quick reminder, click on the subscribe button so whenever we post an update, you'll be notified. And you can watch this entire thing at your convenience. Entire podcast, the YouTube update with all the charts, just click on the subscribe button. If you're nervous with your portfolio, don't feel comfortable, give us a call, 800-388-9700, or just send me an email at invest@compact.com. We'll be more than happy to sit down with you, look at your portfolio, see where you are, and give you some guidance, give you some ideas. There's no cost or obligation for that. Let's start with the numbers, Javaid. A good week last week, came back up.
Yeah, nice bounce back in the market last week. We saw the S&P 500 up almost 3.38%. So a huge week, basically almost erasing about half of the year-to-date losses that we've had. So we're closing last week at 3.58. Clearly, we're recording here on Wednesday, April 8th. So some big news regarding the Iranian deadline and potential escalations within the Middle East. It looks like, at least for the time being, we're on the ceasefire. So we're even building on these gain returns that we had going into closing last week. Dow also up 2.98, Russell up 3.34. Growth stocks really kind of rebounded back. NASDAQ up 4.46, growth up 4.2. And then you see EFA up 3. And then emerging markets, which has still been the best sector for the year, they're up already 3%. It wasn't quite up as much, but we did see a big move in emerging markets today, probably the biggest, almost up 5%, as things seem to be hopefully headed in the right direction regarding the Iranian conflict.
That's going to be interesting to see. We've got a 2-week ceasefire today, but it was unconditional. The president said that they opened the Gulf of Hormuz. They said, yes, the Iranians are saying, yes, we're opening it, as long as you give us $100 billion a year for the ships to go through.
Okay.
That's the only caveat that there is there. And we can continue to build our atomic bombs. We're not turning over any of our nuclear material. And they said U.S. has got to withdraw all of its bases from the Middle East. That's part of the 10-point plan that we're going to start negotiating from. That's what Iran put forward, and seems like the president has said that that's what we're going to negotiate from. So where do we go from here is the question. Will this be acceptable to the United States, basically to give Iran everything it wanted and more than before the war started?
And ultimately, I don't know if even the U.S. with the de-escalation is going to really cause what's causing the disruptions in the market from this conflict, oil prices to come down. It seems like if the Strait of Hormuz is going to be limited, right, because clearly we're not going to give them $100 billion, and if the traffic is not going to resume to what it was, we've seen these flow-through effects on oil prices, and particularly today, I think, and we'll show it on the YouTube update and in the charts, we now are looking at DBO. So it's DBO is a ETF that tracks not only the spot price of oil, but it also tracks these future contracts. And it was down big today.
On the open.
On the open.
Right.
And then it reversed higher throughout the entire day. So we'll talk about a key level later in the YouTube today and podcasts that we're watching on the DBO chart that I think for me, everything, all of these things, the Truth Social tweets, the comments, from the Pakistanis and from the Iranians and everyone, I think it all gets dialed into the oil price. And I think until that oil chart makes a tangible decline lower, we're not out of the woods yet. You can kind of get some good news, then you get some bad news, then you get some good news, so you're fluctuating, but it still feels like we're not quite out of it yet. And we're actually going to show an interesting chart of the week, which starts to make a little demarcation between, is this just a geopolitical event, or is this an oil supply shock that potentially has more market implications?
That's a really interesting chart because it shows the history of geopolitical events, and it shows the history of oil shocks
And their impact on the market.
and the impact on the market. So we'll talk about that a
Yeah.
little bit later on, but it's really oil. That's
Yeah.
what it all boils down to.
Absolutely.
And then it all boils down to the Gulf of Hormuz. Is it open? Is it free flowing? Can the oil come out of the Middle East and get to everywhere else? And because that's what it impacts the global economy. That's,
And it's not only, I think, the transportation, but it's, if there is an escalation and they do start doing drone strikes on key infrastructure in Saudi Arabia, in Kuwait, in Iraq, that oil now, even if you open up the strait, it's not being pumped, right? Because the infrastructure is now destroyed. So there's still a lot of kind of moving pieces here. I don't see the Iranians just kind of laying down. And so I think you still need to kind of tread lightly, even though we're seeing a great update today in the market. It seems like this is an energy shock that could last for some time. And so you just need to kind of be prepared for that and potentially the volatility that it's going to entail.
So last week we saw consumer services had a good week of 6.4%. Energy was the worst sector last week, down 5.3% for the week.
Yeah, absolutely. So down, and so I think that's a good sign. We, potentially as the market was kind of maybe sniffing out that there was going to be some sort of ceasefire and cooling of tensions for a little while.
Right.
And then we've kind of now seen the reversion back to things that have been getting hurt most of the year, which has been kind of technology and consumer services. So you kind of saw that Magnificent Seven, that AI trade really come back in favor last week. So I think overall, 1 week type of movement, but the one thing I really emphasized on the YouTube and the podcast last week was the bond market was saying, hang in there. We'll talk about the relative strength charts again that now we're including on a weekly basis. And really that was just, and I think that was foreshadowing a little bit of the positive news we're getting today.
Yeah, but that same thing happened on that relative strength chart. The HYG took off this morning, and then by the end of the day, it drifted all the way down.
Yeah.
I mean, wasn't negative.
Still positive.
Still positive for the day, but it gave back most of the gain, just like oil did. Oil plummeted this morning, and by the end of the day, it came right back up.
Well, and I think that's when you really start to understand the signals that the market is giving you. It was interesting because this morning, just on my my WhatsApp and some of my friends, they're like, "Oh, look at all the green on my screen! I love it." But I'm looking at this oil market reversing through the day. You look at these intraday moves; those tell you a lot more about kind of how the market's feeling than these big gap up or gap up or gaps lower that happen because of news overnight. When the market's actually trading and you see those, you talk them. Key reversals.
Right.
And when you see kind of things are really good, but then it sells off, it's those kind of contradictory type of moves that happen intraday that as technicians, I think have a lot more validity in terms of trying to understand where things are headed than, everyone's like, oh, it's over today. Everything's great.
Especially
Market's
if it
done
gaps
great.
down tomorrow. Oil gaps up.
Yeah.
And the markets gap down. They leave an island top. And
Yeah.
I've talked about those for years. And I'll point them out when we talk about the charts a little bit more. Oil, $111 a barrel on last Friday. It was down this morning below 95, then came right back up. So we'll see where we end up. We started the year at $57 a barrel. So we've nearly doubled the price of oil.
Yeah, and we have we're doing our quarterly update for all of our compact clients today. And so diving deeper into these type of metrics. And one of the key things that I thought was interesting is that we have a lot of charts that show that the U.S. is a net exporter of energy, right? Yet, if you look at the oil price increases versus in the U.S. versus non-U.S., they've actually been higher here.
Right.
So we're still feeling the impact. So just because we're a net exporter doesn't mean we're not going to necessarily feel the impact in the Middle East.
Oil prices are global prices. They're not just U.S. prices.
Correct.
So what happens to oil? It's all global. So if there's 20% less oil coming out of the Gulf, prices of oil are going to go up all around the world, including the U.S., even though we are exporters of oil.
Yep.
And it's going to impact the economy. I mean, I was driving on Sunday and on the 405, which is notorious for being packed. I mean, Saturday morning, it's notorious for, there was nowhere on the freeway. And I'm going, what's going on here?
Yeah.
It was just empty. I saw like 20 cars, and I said, this is just unbelievable. It is starting to impact people's wallets. And when it starts impacting the consumer, that's 2/3 of the U.S. economy.
And I don't think we've seen that impact yet. We're going to get the earnings, and I think earnings in the next couple of weeks are going to look really good.
Right.
It all depends on the duration of how long these oil prices stay higher. Particularly for those that are, in the lower, kind of middle to lower, socioeconomic status, they have the greatest percentage of their money goes towards filling up the tank, and their income, their paycheck goes to filling up the tank. And if that kind of core consumer, which unfortunately hasn't really been driving a lot of the stock market returns and consumption, but they're going to get squeezed. I think it actually, in my opinion, when it comes to the effects of higher oil, I don't know if it's necessarily they're huge on the market because we've gone further away from it. I think the biggest implications we're going to have for higher oil prices is political. And the fact that when you're starting to see some inflation, I think that's what really empowered the Republicans to sweep in the last election. But I think the biggest implications are not necessarily market implications. Yes, we're seeing some higher inflation a little bit. Markets kind of taking it on stride. Interest rates have gone up a little bit, but not much. But I think we could actually see a bigger implication when it comes to the political ramifications. We're not going to get into that here in April, but I think that's something to watch as we get closer to the midterms.
It just
here in
depends how
November.
long this oil
Correct.
shock lasts. That's the real thing. If it's just a 2-week thing and oil prices drift down back to $60, $70 a barrel, everything is
it's-
wonderful.
yeah.
It was
It's just an
geopolitical.
episode, yeah.
It was an episode. But if oil prices stay up $90, $100 a barrel, it is going to impact not just the U.S. economy, global economy.
Correct.
And everything slows down.
Yeah.
Everything slows down, and that means when there's less when you sell less of everything, people don't buy as much.
Yeah.
Profits go down.
Earnings go down.
Earnings go down. Earnings go down. The stock market goes down. So it's all related, and it all depends on how long this lasts. And even if we do the ceasefire sticks, but Iran ends up getting $100 billion a year, then we've just mowed the lawn, as the saying goes, and that we've just slowed them down for a certain period of time. But the Iranians are going to come back bigger and stronger.
Yeah, with a
Because-
vendetta.
With a vendetta. Now that you destroyed their country, but they're getting $100 billion, they can reconstitute all of this that was destroyed, or the drones or the missiles, that they can buy them from Russia and China, and they've got all this new money coming in. That would be a big, big problem in the long term, and not taking their uranium that they've refined already. If we don't get that out of Iran, then it's going to be a much bigger problem than we have now.
Yeah.
So where do we go? How long this lasts? How it's resolved? That's all up in the air yet.
Yeah, and I don't think anyone knows. And then I think because of that uncertainty, that means there's going to be volatility. And clearly we're seeing volatility. And volatility doesn't mean just bear markets and going straight down. Volatility means it goes down, but then it pops right back up. And so then if you're getting very emotional when you're selling when it's down, and then it pops back up, and then you're kind of, okay, well, now it's over. Then you get back in and you get kind of whipsawed. You're just going to end up losing money on both sides. And
Right.
so it's really important, and we're emphasizing this once again on the quarterly webinar with clients, to ensure that you are ready for the volatility, particularly with where the valuations are today. And how you prepare yourself for that volatility is ensuring you have the right asset allocation. You have a defense, and your asset allocation matches not only what you're trying to accomplish with your financial plan, but also what you're able to accomplish with your investments when it comes to the emotional risk tolerance.
How much you can handle emotionally. That's the biggest question. When people say, how do you measure that? Well, that's when you sit down across somebody who's got 10, 20 years of experience doing this, where you're talking to people and they understand what you're saying and how to translate that to your portfolio. That only comes from experience, because there's no measurement for emotional risk, how much people can handle. They'll say, oh, I'm aggressive when the markets are going up. Markets go down 1%. They go, oh my God, why is my portfolio down 0.5%? So wait a minute, you're aggressive. Oh yeah, I'm aggressive, but I don't want to lose any money when the markets go down. So that's where you get to sit across somebody who has 10, 20 years of experience and help you, guide you to get you the right emotional allocation and financial allocation. That's really the hard part.
So then we're looking at the aggregate index was up about 0.75, but what I love to see is high yield was up more, up 1.21. So high yield was up 1.21. For the year, bonds have held in there, But like I said, I think when you see these spike in interest rates, a really good time to really be adding to that defense. Bonds are the defense that are on the field. We'll talk a little bit about the treasury rates, but they came down a little bit from 4.4 down to 4.34. But we'll really kind of dive into this relative strength chart.
And that was good last week, really good.
Yeah, it was really good. And as I said, it was kind of been holding up. We haven't seen any sort of, the thing you don't want to see, the big dispersion is, once again, bond prices going up, but high yield prices going down.
We want this to go up more than this.
Yeah, and sometimes you'll see where the bond market will go up and the high yield market will also go up, but less. That's not great, but it's not a big warning sign.
We want this going up a lot more than this. That's really the bottom line.
Just going up in general, but yeah, always going up. As soon as high yield starts going down, it depends on why. Once again, it's not just high yield going down. It depends on why high yield's going down.
Right.
If it's going down because we're headed towards a recession, not good. If it's going down because interest rates are going higher, we'll get through it.
Now, this is a really interesting chart. Mm-hmm. We've got to talk about this, and we've got to look at this and go from there. Mm-hmm. And go from there. That's what we're looking at right now. Short-lived geopolitical stocks. This is interesting because we all talk about geopolitical shocks. Mm-hmm. We talk about this, but you look at this. This is a geopolitical shock. When it happens right here, and you can see what the market goes up. But energy supply shocks, this is different. You can see that it happens here, and this is the dark blue, and it stays for the next year. Mm-hmm. It doesn't go down a lot, but it goes down and then it stays there.
Yeah.
It doesn't come back immediately. And you can see that we've gone down just as much as, or more, in a short period of time here.
Yep.
And so now we could stay here if oil prices do not come down.
Correct.
Immediately.
And so I think this is a beautiful chart because it really kind of, everyone talks about buying the dip on geopolitical. Well, yeah, for the most part, if it is that blue line, you get this dip and then it comes right back. And so you look at a lot of the events that were short-lived geopolitical events. We're talking about 9/11, the U.S. invasion of Iraq in 2003, the the escalation between, in Gaza in 2024, and then Israel strikes Iran in 2025, earlier last year.
But these are short-term geopolitical events.
Yeah, and it's more military, it's more kind of military events going on, but you don't have oil or some sort of natural resource.
Oil prices did not go up like crazy during these things.
Correct. And then if you look at these other oil supply shocks, you go back as far as the oil embargo in the 1970s or the Iranian Revolution, 78, the Iran-Iraq War in 1980. So when you have these, even the Iraqi invasion of Kuwait, and then the Gulf War in 1990, and then specifically the most recent one, Russia and Ukraine in 2022, these all had big kind of implications. Once again, Russia being a big oil exporter, clearly the Middle East is the center of oil production for the world. So I think that's something that is a little bit different this geopolitically. And so when you have these energy supply shocks, you just have to be a little cautious, I think, about really getting aggressive and buying the dips. As long as the earnings continue to hang in there, then yeah, the market will recover, but you just don't know. And who knows, maybe it does get worse. If oil prices go higher, they don't have to go higher for much longer for those recessionary risks.
Or even if they stay here, if they're where they were on Friday, $120 a barrel, $111, $12, $115 a barrel, that is not sustainable. Mm-hmm. That's going to be a problem for the global economy. Yeah. So we have to get these oil prices back down. How do we get the oil prices back down? We have to open the Gulf of Hormuz. But how do we open the Gulf of Hormuz? Do we give Iran the billions of dollars they want for every oil tanker passing through? They want $1 billion.
Yeah.
So if there's 100 tankers going through,
that's not going to happen. So I don't. For me personally, I don't know how it's going to get resolved. I think it's going to linger for some time. I think the oil markets are telling us that. I don't necessarily think it's even. I think we'll get in if we think it is going to cause a recession. So let's just, because that's what we worry about. If it doesn't cause a recession, we're fine. Right. Market's going to recover, things are going to get better. But if prices stay here and they don't go down soon, then it starts to put gradual pressure on the economy. I think the Fed has some wiggle room there to cut some rates. and to kind of stimulate things a little bit if that scenario comes around. So even if we do go into, things start to get, and I don't know how much oil really also impacts the whole data infrastructure, all the AI boom, all of that. Yes, it affects the consumer, it affects consumer discretionary, those type of things, but tech sector is still going to chug along. I think that it's still manageable. It's not going to be great. Prices are going to be down, and maybe we go to 6,000 on the S&P, et cetera. But I think it's somewhat manageable where, that's just really maybe hopefully setting up another great buying opportunity for that leg up. So I don't want, it feels like it's if that does continue, it's not going to be the end of days, but
It's not the buy the dip and not worry about it.
yeah, so it's going to be a little bit more nuanced. And that's why when you kind of have that uncertainty around the stock market, I kind of really like bonds here because
Right.
bonds are going to basically just give
You've been
you that
saying
income.
that for the last 3 weeks, 4 weeks. The
Yeah.
bonds are a great price right now. The interest rates have gone up, so you can lock in those higher rates
Yep.
at this point in time. And they just sit there, enjoy your interest in the meantime, and not worry about the gyrations.
And even high yield. I haven't liked high yield, but in the last couple of weeks, the high yield spreads have widened. They didn't get crazy. So even high yield, if you keep your duration relatively short, if you want to mix it in, knowing that it's a riskier, it's not your investment grade bonds, that's even a place, if you want to get risky, you can dabble a little bit, but at least you're getting that coupon. At least you're getting those interests that are much more going to be dependable than clearly all these outcomes in the Middle East.
Non-farm payroll, the economy is chugging along, much better number than expected.
Blew away the numbers. The jobs number were great.
Tripled what was expected.
I thought AI was going to take our jobs.
I know, but I guess it didn't.
We're still
I guess,
here.
Well, AI, I guess it got worried about the war or something. The AI got scared. But it was 60,000 was the number that was expected. We got 178,000 jobs created. So that was a lot better than retail sales were up 0.6. Job reports, job openings fell. So that means there's,
Economy, I mean, if you look at all the economic factors, and the only thing that's kind of a little bit worrisome is a slightly higher inflation in oil.
Right.
But everything else, retail sales, job, interest rates are rather muted. I think it's all going to get reflected in pretty good earnings here in the next couple of weeks, and that can really help the market. Now, once again, if oil prices are still here or higher, market's not going higher. But
I mean, if we get oil prices down to $70 a barrel again,
I think we're at all-time highs.
We're off to the races. But if oil stays here at $110, $115, $120 a barrel for another couple of months, it's going to create some problems. It'll create a slowdown.
Yeah.
I don't think it
It's not a
pushes
crash.
into. It's not. It doesn't push us into a recession,
Mm-hmm.
but it'll make things tough for the economy, for the consumer, and for the global economy.
Yeah.
Not as much as the U.S. economy, but for the global economy.
Correct.
And we're all interconnected. It doesn't matter what happens only here in the United States. What happens in Iran, what happens in the Middle East, shows up on your gas pump every day. That's the problem. And so everything is interconnected. So I have to watch this and see how long it lasts. The duration is critical. We saw the non-manufacturing index still above 50, even though it came in a little bit lower
54
at
is
54,
still
but
great.
still above 50. And so it's pretty good. As long as it's above 50, that means it's expanding. Anything below 50 means that it's contracting. So manufacturing is still expanding. That's what we're seeing. Rest of it, we get the final report of the GDP. Those are already there. Not a lot coming out until the 10th, which is CPI.
Yeah, and even CPI, I think is going to be. It's a little bit kind of stale news, right? Because this is.
It's
it's
March
reflecting. It's kind of March data. It's going to somewhat reflect what we're seeing with oil prices, but not a lot. But I think the other thing that I think you've tangibly seen a slowdown also in housing.
Right.
Housing, as interest rates have gone up with the higher inflation, housing's kind of slowed down. I don't know if it's necessarily impacted prices per se, but that's the key component within the inflation piece that I always really look at is what is shelter doing. And I feel like with interest rates going up, probably home prices and everything have been coming down over a period of time. So net, inflation still kind of somewhat contained.
Looking at the technicals, again, we came down, broke the 200-day moving average, which is 66.20 today. But then today we were below the 20-day moving average. But on Friday we saw what is called a hammer bottom. And from there, we popped up all the way here, gapped up.
No,
Well,
big
from
gap,
here,
above the 200-day.
Above the 20-day, above the 200-day, right at the 50-day moving average, right there, which is at 67, 68. We were right there. 71. We're right there.
Yeah, gaps make me nervous.
I know, because gaps usually come back and get filled.
Yeah.
Tomorrow, if we open below 67.40, that's the number I would be watching. Then we leave an island top. This is going to be by itself. We open somewhere down here. That would usually marks a top in the market. So it all depends on the news that comes out overnight. And I think it'll just bounce around here until we get some clarity on this ceasefire and what the agreement is going to be.
Yeah.
And the negotiations are going to be in Pakistan and Islamabad, where we're going to have, I believe, the vice president is going to be there and the Iranians are going to be there. So we will see what the agreement is for the ceasefire. So, but I think this was a great day today, but it gapped up. This gap is just too big right here.
Yeah.
Right here. It's just a huge gap that we saw today. We'll have to wait and see how it turns out over the next couple of days. Same thing with the weekly. We were down below the 50-week moving average. Last week we came back above it. Today 68.04 is the 20-week moving average. We were there, the high of 67.93. So we came and tested that. Again, we have to get going above this 20-day moving average, 20-week moving average to really get exciting. So it's the 50-day moving average and the 20-week moving average.
When you're looking at trades.
Exactly, that's what I'm looking at. NASDAQ gapped up again, huge gap. Again, you can see this, where this was last week and where this is today. There's just a massive gap. How this gap gets resolved, but again, you can see we opened at the highs, closed right at the lows of the day.
Not good.
Not good. The low of the day was the 22,501. We closed at 22,586. So we came way down from the highs.
So you could tell then there was a lot of optimism with the Middle East, but a lot of people throughout the day today were fading this rally.
That's exactly what was going on. It opened, everybody starts selling. They said, this is
an opportunity to get out.
Get out, and that's all it was. And everybody was looking at saying, oh, I've got green on my screen, and they were all excited. But I said, I still think we need to
brakes
a little bit here. We've got to sit down and look at it. NASDAQ, again, weekly chart, looking much better. My dot plot, still negative.
Still up there.
Still up there. It's at 23,509. We're 22.6. They were about 700 points away. So from where we closed.
So really, once again, S&P's got to get above the 200-week, and then most likely NASDAQ's following it up. Then we're kind of in the clear. But we still have some ways to go before we're.
But interesting part is we could have completed 4 right here, and we could start a 5th wave to the upside.
Yeah, I talked about it last week on the YouTube and podcast. I don't know. I still feel like we're not out of the woods yet.
Well, 4th waves are choppy.
I think this is the A. This is your A, the big one.
Oh,
then
okay.
Now we're in the bounce, the B, and then we get one final.
So you don't think this is ABC?
No.
C.
No, I think that's the A right there.
This is the A. That's what you're saying.
And then we still have a little bit more to go. Dot plot. You got to kind of get everything charged. It just feels when you get big turning moves in the market, particularly with these big events going on. This is not a small event. 20% of oil production is disrupted right now in the world.
Right.
Like that's a big event, and
Right.
you look at it relative to history, it's never been bigger in terms of how much of a disruption it is. And for the market to react to how it has, which is good, it just seems a little too good to be true. It just seems like, okay, things, and I'm not quite experiencing the capitulation sometimes that I get from clients or from other people where when they're really scared, is usually, okay, now we're finally close to a bottom.
And the fear was not there.
It kind of hasn't been, you've seen VIX go higher a little bit, but it came back down. So that's why I'm still just saying, let's just slow down. Don't get too enthusiastic here that I missed it. I got to get in.
But don't get too depressed either.
Yeah, you got to hang in.
Market is down just about 1% down for the year.
Yeah.
When you add up to this.
That also enforces my point. It's not even down that much for the year. So.
Yeah. Weekly small cap took off today.
Okay.
Big move up, 2.61% on the upside today, and it closed on its highs.
Yeah.
It wasn't like the NASDAQ and the S&P, which closed on its lows, but this closed on its highs. So we'll have to see if we can get some. Same thing with the international index. Again, closed right about its highs. high today was 91.80. We closed at 91.08. So close to the highs of the day from where we were. So a big move to the upside. Oil chart, here's GBO.
Yep.
It started, but closed pretty high on the other hand.
Yeah, so it opened lower, below 19.
Right.
And then it closed right there at 1971. It's that, I look at that key point on the chart right there around 19. That just 19 level is
Right
kind
here?
of a little higher. That A,
Yeah.
that low, that you just draw a line right there on that dotted line right there. I think that's when really the market has settled in. That decline we saw in oil prices earlier was, I think Trump kind of articulated, hey, we're done, or we're going to get done, and then the Iranians are like, what are you talking about? We're just getting started. Oil went right back up, and then it's come down. So we kind of continue to plumb that bottom of the range, which is good. We don't want to go into the top of the range, but until I think we get a tangible break below 19, we're not out of the woods yet. And
So you're not buying this ABC?
No, I don't. The Elliott wave, all of that. I think, yeah, that the A is too shallow, the B is too close to the third wave top, and the C is too small. I think you still have.
Yeah, I think you're absolutely right on
Yeah.
that because it doesn't show a fourth wave.
Correct.
And the fourth waves are usually much more choppier. They go up and down for a period of time. They're not like simple bottoms and just go V bottoms, go down, come right back up. That's what we're looking at. Here's the weekly chart for oil. And, it was big down, but back up again today. So have to wait and see.
You can see last week it was down a lot.
Yeah.
Oil chart was down a lot last week, and that's what fueled the returns in the stock market last week. So it's very much driven. This is the key chart to watch throughout the entire conflict to really understand where's the market headed, I think, in the short term.
Yeah, this is the 19 area that you're talking about. And this is about 21 right up here.
Yeah, so break above 21, all bets are off. Once we get below 19, then we can we can start to wave the all clear flag. Yeah.
Interest rates were down big this morning. They were down to 4.23, but came right back up. 4.29.
So once again, it was that kind of almost like a head fake. Like
Yeah.
I said, over the last couple of weeks, been more attractive. I think anything above 4.35 is a pretty good time. All spiked almost up to 4.5. But it's still just kind of chopping around. But I'm cool as long as interest rates chop around 4.3%. And
We're okay.
That's a good thing. And,
And
I think the key thing to really emphasize is my move index.
Right.
It's come down dramatically.
Oh, really?
So that's the volatility on interest rates. So that tells you the magnitude. When I see move index move higher, that gets me scared because then that means interest rates can move a lot, and if interest rates start moving a lot, the stock market's going to move even more.
A couple of weeks ago, it was above 100.
It was at 110. So
Yeah.
now we're all the way back into the 70s. So that's also, I think, a good sign. Things are progressing in the right direction, but we're not quite
done yet.
But at least I think maybe the big dramatic things of everyone worried about, okay, World War III and all these other things happening, those seem to be diminishing as we go along.
Gold came down from 5,000 to 4,000. It was down to 4,000. It's at 4,300 now, just about today, 4,400. That's where we are bouncing around, but gold is gold. I think gold disappointed a lot of people. Everybody thought gold would explode up after this war, but people said, we're not buying that.
Well, and I think a lot of the central banks, they're having to liquidate some of the gold, to as things are getting a little bit more difficult. So gold, I kind of still, relatively like it, but I wouldn't be putting all my money.
Here's an interesting chart. This is
This is your relative
This is
strength
my
chart.
relative strength. It just shows you, it takes both of them and puts them together. You can see that this is high yield was coming much down faster. It was going down faster than AGG. Today it had a big day up. It was doing much better, but by the end of the day it closed here. So still a gap higher, but not.
Yeah, and I think you just, with these type of charts, you just want to follow the general trend. So, the trend was, definitely we had an episode of higher interest rates, and so it's gone down recently because clearly, there is higher risk of recession. Yet, you still look at the trend just over the last, let's say, since middle of March, it's been kind of sideways to up.
Right.
So that's very positive. It's definitely not continuing down to the
We
downside.
made a bottom right here, and since then, that was a bottom in the stock market too, by the way.
Yeah.
And from there, for the last week and a half, we've been going up, which is a good relative strength. So those are our thoughts, those are observations. For
Yep.
all of our clients, tune in tonight. We're going to do the quarterly update where we look at the last quarter, look at the next quarter, a little bit of longer term perspective and what we are doing here at Compact to bring you up to date and our views and our thoughts. For all of you, you can subscribe to this channel. Whenever we post an update, you can come and watch it, you can come and hear it. It's all here and it's all free. So click on the subscribe button. If you need help with your portfolio, send us an email at invest@compact.com or give us a call at 800-388-9700. Thank you again for spending this time with us. We will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Javaid, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.